Hello, everyone, and welcome to today's webinar, Forgiveness in 2021, How the Economic Aid Act is Changing PPP. And today's session is going to be focusing on loans that are for more than $150,000. I'm Yonina F. Shineweather, CPA, the Consulting Director of Compliance at Viventium. And today we're going to be taking a real close-up personal look at the forgiveness process. And I want to kind of start off with just a compliment to all of our participants that you're really looking at this with a far-sighted vision, because at a time when many people are still dealing with getting their loans or loan applications, you're taking the long-term look, which is not really so long-term, and that is, okay, fine, we get the loan, we got the loan, second draw, first draw, whatever it is, what's going to be about forgiveness? And what things do we need to start accumulating now so that when it's time to turn this loan into a grant, we're not like, oh, we didn't have that, oh, we didn't realize, oh, we made a mistake. So the real time to be thinking about forgiveness is from the very beginning of your covered period, and that's what we're going to do today. And we're actually going to very much concentrate on the form and the process. We're going to dissect it, we're going to pull it apart, we're going to really analyze it, and then we're going to learn how to put it all back together. I want to stress a couple of important points before we get started. Point number one is that Viventium is not an authorized SBA lender. I know we've actually gotten some questions about that, but we do not underwrite SBA PPP loans. We do not offer advice, legal, tax, other type of advice regarding PPP loans. What we're here to discuss today is what the law has said, what the new forms look like, the guidance, the interim final rules that have been issued regarding it, and any questions that you may have or any final decisions that you want to make should be solely based on consultation with your own business advisors, be they CPAs or lawyers or consultants. That's point number one. Point number two is that today's webinar is being recorded, and I want to invite you all to use your questions toolbar, and I see some of you already beginning to take advantage of it. I like to say that if there's something that you're not understanding, then probably other people aren't understanding it either, whether I'm not explaining it clearly or talking too fast or you just whatever it may be. So please go right ahead and do use your questions toolbar. I will try to keep my eye on it. And if there's time at the end, allow some time for Q&A, although we have a real lot of information to get through. One more point is that I know this is always asked, the slides will be provided to you after the webinar, as will a recording of the webinar so that you can share it with your colleagues or review any points that may not be clear to you. And at the very end, there's a nice bonus, which is one of our famous Viventium infographics that our great marketing people put together. And it kind of gives you a roadmap of PPP forgiveness, just to kind of keep everything in perspective, what happened when and where we are now. In a separate session, we'll actually be focusing on loans that are under $150,000. And for those of you who are not quite sure, you may want to attend both, because the second session will be addressing the 3508EZ and the 3508S. Today's session is going to be looking specifically at the 3508 itself. Okay, enough housekeeping. Let's jump in and get started. What has happened to change PPP? So if we take a step back and we look at the source is a law that was signed into law on December 27th, 2020. And as we'll see, that date keeps coming back. It keeps resurfacing in the instructions and in the form. That December 27th, 2020 is going to stay with us. And the law was called the Economic Aid Act. Now, really, the Economic Aid Act was not a standalone law. It was part of a much bigger collection of legislation called the Consolidated Appropriations Act 2021. That was basically a $2.3 trillion spending package, federal budget, and it contained this consolidated CAA, as it sometimes you may be seeing a reference to CAA, the Consolidated Appropriations Act, contains 32 divisions running from letter A, division A, B, C, D through FF. There are two divisions that are particular concern to employers in terms of payroll, and that is division N and division EE. Today, we're going to be looking only at division N, which is sometimes titled the Additional Coronavirus Response and Relief Act. And that division contains the Economic Aid to Hard-Hit Small Businesses, Nonprofits, and Venues Act. Now, that Economic Aid Act, as we'll call it for short, contains an extension and an expansion of the PPP that's administered by SBA. So this is all coming, if you want to know where it's coming from, it's coming from the December 27th federal budget, and specifically what's being called the Economic Aid Act. Let's take a look, before we jump into the forms, let's take a look at the key provisions. First of all, there are more categories of employers that now qualify for PPP. Certain types of agricultural concerns, certain types of media, newspaper that had previously been excluded because they were part of larger conglomerates, certain types of direct marketing, DMOs, direct marketing organizations, and of course, all the employers who qualified before still qualify for PPP. Another change made by the law was that now you can count more expenses for forgiveness. And we're going to be looking at this. Originally, you were only allowed to count payroll expenses and then mortgage interest, rent, and utilities. A lot more is being included now. We're going to talk about that. So that's good news for employers. Basically, the Economic Aid Act created another round of PPP loans, but only for certain businesses. You can't get a second draw, as it's being called, if you're publicly traded. You have to have 300 or under employees, and you have to be able to show a decrease of 25% in any quarter's revenue compared to 2019. Now, the full amount of your first loan has to be finished. You have to have used it up before the disbursement of your second loan. Not necessarily before the application for your second loan, but of course, check requirements with your individual lenders. What they are going to ask you to do, and we'll see it when we take a look at the certifications, they're going to ask you to certify that you've used up all your first disbursement, all your first draw loans. They're calling them first draw and second draw. And you can't get your second draw before you've used up your first draw. So people have asked, can we take a second draw from a different lender than our first draw? And the answer is absolutely yes. You do not have to go back to the same lender. It might actually be easier for you to go to the same lender, because what some lenders are doing is they're allowing you to just, build on the application that might already be on file, and, and they'll automatically upload or import that information into your new application. So it may be easier to go to the same place, but it's not required. Now, first draw loans under the Economic Aid Act can be increased. In other words, since we said there's new expenses, all different types of new categories of expenses that now count toward forgiveness, you're actually allowed to increase your first draw loan. However, what we found is this is not being supported by some lenders, or at least not supported yet. And so if you reach out to your SBA authorized lender and they say, what, increase your loan? No, you can take a second draw, but we're not going to let you increase it. Well, that's fine. What they will probably tell you is not yet. And the reason they're telling you not yet is because SBA hasn't really issued guidance about how to go about expanding your first loan. So it's kind of a decision that you're going to have to make. Do you want to hang in there and wait for that first draw guidance expansion to be issued and go for it? Or do you want to just forget about it and go for a second draw loan if you're eligible? Note that whether you're a first-time borrower, let's say you never even went into PPP before, and you were afraid or you were nervous or whatever it might be, or you just decided the time has come that you meet the qualifications and you're going to go for a first draw or a second draw, you can't get more than $2 million. The original loans, if you remember, were for $10 million. In this second round, both for first and second draw loans, the max is $2 million. Another important fact, and again, those of you who may be in this category, I really want to invite you to attend our session where we focus on loans that are under 150,000. It's actually 150,000 or under. And that is, forgiveness has been simplified, or at least we think forgiveness has been simplified. What it really means is the forgiveness form has been simplified. And we'll go into that in depth, including the pitfall that we can actually make if we think that forgiveness is simplified and not just the form, but that's not for today's session. Today we're focusing on that, loans that are 150,000 and more, people who are not eligible to use the 3508S. Now, another very welcome development in the Economic Aid Act was that you can now take a tax deduction even if you claimed your expenses for PPP. That was something that the business community was lobbying for extremely, extremely strongly. And the IRS was basically towing the line that no, if you take expenses on PPP, which means basically that the government is paying those expenses for you because it becomes a grant, we're not also going to let you have a corporate tax deduction. Well, Economic Aid Act conceded to all that lobbying effort, and they said, yes, we want to help businesses as much as we can. And so whether it's the old first draw, second draw, you can claim a deduction for your PPP expenses. And finally, something we're again not going to elaborate on today. If you visit Viventium webinars, you'll find more information about this on our webinars or on our information sites. And that is the employee retention credit. If you remember, there was a kind of a mantra the whole 2020. If you take the ERC, you can't take a PPP loan, or vice versa. It was more often, well, since I took a PPP loan, I'm not going to be able to get the ERC. It's one or the other. And the Economic Aid Act changed that. And now employers are allowed to claim that employee retention credit, even retroactively. You can go back and amend your second, third, and fourth quarter 941s for 2020 and claim that credit retroactively. So more about that in a different place and a different time. What I want to focus on today, let's start getting very detailed, are the 5 changes to forgiveness. Now, these changes apply to all new loans. Whether you're getting your loan for the first time in a first round, or you're going for a second draw. In other words, this is the second round, but if you're going for a first draw or a second draw, this is going to apply to you. What if you have an existing loan? Do these changes apply to an existing loan? Let's say you're not eligible for a second draw. What does that do to your forgiveness? So if you've already submitted your application for forgiveness, do check with your lender, because special rules may apply. If you've gotten forgiveness already, it's finished. You can't do it. You can't get any, even if you only got partial forgiveness, you can't go back. If they actually made a forgiveness grant to you, even if it wasn't full, there's no provision for you to go back and benefit from these additional expansions and expenses. What if you just submitted the application and it wasn't yet addressed? Well, that's something to check with your lender and with your tax advisor. What we do know clearly is that if you haven't applied for forgiveness yet, let's say you took a loan back in April or May, and you just haven't sent in your forgiveness application yet, then yes, these rules apply to you as well. So you're going to be able, you'll have a better chance, a better shot at getting full forgiveness, because there are additional expenses that you can include. So let's take a look now. We've been talking about all these expenses. What are they allowing you to count on your forgiveness, also on your loan application and on your forgiveness application? First of all, the non-payroll expenses. If you have operating expenses such as product and service delivery, sales and billing, back office type of stuff, payroll and HR fees, cloud computing, property damage costs due to the public disturbances of 2020 that were not covered by your insurance carrier, supplier costs, if it's supplies that are essential to operations, or if it's by a contract that pre-existed your covered period, or for perishables, even for a contract during your covered period. Worker protection, that would include PPP equipment, that would include any modifications to your facilities that you needed to do in order to comply, not with state rules about COVID, but with Health and Human Services, Center for Disease Control and Prevention, or OSHA. Any of those rules or guidance or requirements that were imposed upon you, and you had to lay out money to make those modifications to ensure safety for your employment force, those expenses are going to be allowable toward forgiveness. And in theory, you can even increase your first loan amount based on those expenses. Again, that's something that not all lenders are allowing at this point. I think everyone's taking a kind of wait and see approach. Let's wait and see what SBA is going to say about this. However, one giant caveat here is that all of these great additional categories of expenses, very, very big expansion, still can't exceed 40% of your forgiveness amount. In other words, at least 60% of your forgiveness amount has to be for payroll expenses. Okay, so it's nice that they're allowing all these additional expenses, but if you don't need them, if you are anyway using up your full loan through payroll, or you're just, it's going to be more than 40%, then it doesn't really help too much. What is probably more significant to most of us is that there are new expenses being deemed as payroll expenses. We know already it includes salaries, compensation. We know that it includes paid time off, except for paid time off under the Families First Coronavirus Response Act, the what we call the FCRA, FFCRA. That type of leave is not included. We also have a coordination. We'll take a look at it a little bit later today. We have a coordination with the employee retention credit, that any wages for which you claimed that retention credit cannot be used as PPP payroll costs. but there are new things that can be. So we already knew that any employer contributions to health insurance or to employee retirement plans, like an employer match, or any employer contributions, payments of state and local taxes, payroll taxes, not federal, not like FUTA, but SUTA, any type of local employer tax that there may be. We already knew that those were allowed to be counted in payroll. Now there's an expansion. It's not just employer payments for health insurance anymore. It's employer payments for employee group life insurance, vision coverage, dental coverage, any type of insurance paid in for employees, and that includes disability. And that would even be if it's a state requirement, like in New Jersey, where employers have to pay disability, have to contribute to their employees' disability funds, that would still be considered a payroll expense. That means that helps you toward your 60%. It's not just like an external non-payroll expense. That is very good news, and we will see this in practice when we go hands-on into the forms. Change number 3 is that the covered period has gotten flexible, variable, we might say. You know how it used to be 8 weeks at the very beginning. Then they said, okay, 8 weeks or 24 weeks, or just 24 weeks if you were after, the PPPFA. 8 and 24, those were the two choices. Well, now they said, why are we being so, locked in? It's not 8 and 24. It's any date between the beginning of your disbursement. It has to start from your first disbursement. That's when your covered period starts. And you can count 8 weeks from that first disbursement. Any day between 8 weeks and 24 weeks is eligible to be the end of your covered period. Again, the beginning of your covered period is still your disbursement date. You can, though, choose to designate the end of your covered period, and it could be any time between 8 and 24 weeks. So, for example, if you're partnering with Viventium, we allow you in the PPP payroll cost reports to specify now which date you want to choose. And if you don't know, well, no problem. You just run that report. There's no charge at all. You run that report as many times as you want, and you see which way, if I do 8 weeks of payroll, if I do 9 weeks, if I do 10 weeks, where am I getting up to maximum forgiveness? So that's fine now. That's been made flexible between 8 and 24 weeks. Your period cannot end after September 30th, 2021. And the concept of the alternative covered period, as we'll see when we go into the form, is gone. And just to refresh your memory, you could have picked like the payroll beginning after your loan date just to make it easier. We don't exactly know why they took that off. It seems that it would make things easier for employers not to have to split payroll periods. But it's not included on the new forms, as we will see. Change number 4, well, we're not going to get into in too much detail in this session, although again, I want to invite those of you who believe it may apply to you to take a look at our upcoming webinar on Simplified Forgiveness. And that is, if you have a loan for less than $150,000, you just fill out a 1-page form with no documentation at this point. You will have to submit documentation. You don't have to submit documentation when you apply for your loan, but you will have to perhaps include certain documentation at time of forgiveness. Now, if your loan is less than $50,000, even lower, you don't even have to worry about wage reduction or FTE reduction. So there's a lot to be said here. There's actually a very big pitfall with people for smaller loans here, but we'll cover that in a different webinar. Our 5th and last change to PPP is that there's a certain safe harbor that you're probably familiar with if you've started to look at the forgiveness forms, that says that if you had wage reductions, meaning you reduced your employee salaries, or you had headcount, full-time equivalency reductions, and those reductions happened during what then was deemed to be the height of coronavirus, February 15th to April 26, 2020, little did we know, but that's the dates written into the law. If the reductions happened during that time, and then those reductions are restored by some date that you pick, called the payroll comparison date, then you won't be penalized as long as you brought your numbers back up. So there was a rule that that date could not be after December 31st of 2020. That has now been extended to September 30th of 2021. And there's actually a mistake on the form, and this is one of the things we promised we would discuss. Unfortunately, SBA didn't quite get that it's a flexible date until December 31st when they did their form. We're going to take a look at this so you'll see what I'm talking about. And when you complete your forms for forgiveness, hopefully by then it'll be corrected, but it's something to watch out for. By the way, I want to mention that even though we're going to be looking at the Form 3508 as it's issued by the SBA, it may well be that your lender, your financial institution is using some type of an online form or a substitute form or their own, that's fine. That's fine. It doesn't have to be the official SBA form. All the information is going to be the same. So what we're looking at today is very relevant, of course, but you may be seeing it like screen by screen. If you go into your lender, they may, but it's all there. We're just going to be using, since, I want to uniformize this, so we're not going to have to look at all the different lenders' forms. We're going to be using the SBA form. So Form 3508 is the long form, the longest way of getting forgiveness. Again, there's the 3508EZ if you meet certain requirements, which is an easier form and it's only a 1-page. And then there's a 3508S, which is a simplified form, not for today's webinar. We're going to look at the long one, the 3508, and this is used for forgiveness both for first and second draw loans, but not together. If you have 2 loans, you have to file a separate 3508 for each of them. You would only want to do this painful process if you can't use the 3508EZ or S, unless you're a masochist. It consists of a main form, a page full of certifications, something called the Schedule A, and then something called the Schedule A Worksheet. And they all flow into each other, and that's what we're going to be taking a look at. How do they flow into each other? But first, what has changed? Well, on the main form, here it is. First of all, the date is revised January 19th. The expiration date has been extended, of course, into 2021. Notice that there's now a checkbox. You need to indicate, are you a first draw or a second draw? You can't check both. If you check both, your form will be invalid. You have to do a separate forgiveness process for each. Even if you have both and you're now ready to apply for forgiveness for both, you need to do a separate form for each type of loan. Another change is that there is no longer an alternative covered period. As I mentioned before, you used to be able to specify that you wanted to start counting your payroll costs as of the first payroll beginning after your loan. And that was really convenient. And of course, Viventium's report supported that. They've taken that out. We don't exactly know why, but they probably decided that dealing with a variable covered period length is enough flexibility for employers. And you do need to start on the date of your loan, even if it does not coincide with the beginning of a payroll cycle. So there'll be some adjustments necessary there. Again, if your partner is sophisticated enough like Viventium, we do this for you. In other words, if you just put down the date of your covered period, we're good with that, and we're going to include all the necessary costs that are allocated to that covered period, even if it doesn't coincide with the beginning of a payroll. What else has changed? Lines 5, 6, 7, and 8. Here's those expenses that we talked about, your operating expenses, property damage from riots, supplier costs, and PPE or facility modification for worker protection. It's all here, lines 5 through 8. Again, I want to remind you, these are non-payroll costs, so don't get too excited. They are subject to the 40% limitation. 40% of your forgiveness, the amount of these costs cannot, together with lines 2, 3, and 4, which are also non-payroll costs, all those together can't exceed 40% of what you're applying for forgiveness for. Something that's not on the form, if you look carefully, and that's your EIDL advance. Those of you who got an economic injury disaster loan advance, it's no longer being deducted from forgiveness. You don't need to be repaying it. So that's good news there for those of you who got that advance. It's gone from the form. Now we come to the second page of the 3508, the certifications. Well, it's still a full page worth of certifications and basically looks the same, except when we start to read, we note some very important differences. Non-conformance, different limits for owner employees. Going back on the old forms, owner employees were limited to the regular limits. You can't count, I didn't mention this before, but just as a review, you can't count into payroll costs more than $100,000 for any one employee. And that $100,000, we're going to see this on the form, that $100,000 gets prorated. So if you, in the olden days, if you used an 8-week period, it was 8 50-seconds of $100,000. That was your limit for any one employee. That was the $15,385. If you were using a 24-week limit, it would be prorated to 24 weeks. Now that it could be any time between 8 and 24. So the prorated amount that you can claim for each employee is whatever you've decided. If you take a 10-week period, it's going to be 10 50-seconds of $100,000. So owner employees, and they specify those who own 5% or more of the company, are included in those regular limitations. And in addition, there's an additional limitation. And the additional limitation was different. It used to be that if you were 8 weeks, you had to look back to 2019 and cap it there. And the 24 weeks also went back to 2019 here. And it depended if you were 8 or 24 weeks. Here, what they want you to do is they're saying that an owner employee, and again, they specify here, which they didn't before, 5% or more, the amount that you include in your payroll forgiveness can't exceed 2.5 months worth of the year that you used for your PPP loan. So again, if you're using an old loan, you use 2019. If you're coming to get a draw now and you're using 2020, it would be 2020. Whatever year was used to apply for your PPP loan, that's the year that you have to take 2.5 months worth of compensation of the owners, and that can't exceed $20,833, and that's regardless of how long your covered period is. So that's a divergence from what we had before, and we have to be careful of those of you who have owner employees, have to watch out for that and know what you're certifying and know what you're including. Of course, you know, if you're, I keep saying, if your partner is sophisticated, Viventium has this programmed. Those of you who are with Viventium can breathe a sigh of relief. The numbers that we're going to give you for owner employees are already adjusted for these limits. Another new piece of certification is that you've submitted all the required documentation for the new expenses. It used to just read mortgage interest payments, business rent, or lease payments, utility payments. Now, of course, since we have these additionals, they've changed the language, so you also have to submit proof if you're claiming covered operations or supplier costs, property damage, or worker protection expenditures. So we would expect that to be there, and it is. Now, here's a brand new one. If this application is for a second draw loan, you now certify that you have used up all your first draw loan amounts already. We mentioned that at the beginning. If you're applying for, you're really not even supposed to be getting a second draw loan until you've used up your first draw. And certainly when you're applying for forgiveness for your second draw, they're going to require you that prior to certify that even prior to the disbursement of your second draw loan, you would used up your first draw. That's one of your certifications. And down at the bottom here, remember I told you we're going to keep seeing December 27th repeating itself over and over because that was the date that the Economic Aid Act was signed into law. So take a look what it says here. There are certain safe harbors, we'll discuss them in a little while, that even if you cut your wages or you cut your full-time equivalency headcounts, you won't be penalized, your forgiveness will not be reduced. One of those safe harbors was that you weren't able to operate between February 15th and the end of your covered period at the same level that you were operating before COVID, before February 15th, because you were complying with guidance issued between March 1st and December 31st, issued by either HHS or CDC or OSHA. Now, that has been changed, and now they've said that if you have a loan after December 27th, it could be any law passed anytime between March 1st, 2020 and the end of your covered period. So you realize that that's pretty good, meaning if you're taking, let's say, a loan in this round, and let's say your covered period is going to end sometime in sometime in May. And during that time, OSHA or HHS or CDC comes out with new regulations that cut your ability to do business at the same level that you were doing it on February 15th, you will now fall in. So you can't, so you might say, well, I lost out on the safe harbor because these weren't passed before December 31st, 2020, these new regulations. So no. So the Economic Aid Act has extended that law deadline that if you have a post December 27th loan, then any law that's passed between March 1st of last year and the end of your covered period, and that affects your level and ability to do business, that will make you eligible to be exempt from having to worry about FTE reductions. Okay, let's leave the certifications behind and move on to Schedule A. Schedule A is a supporting schedule. It gives detailed information that then flows through to the main form. The flow we're going to see soon. First, I just want to focus on the changes. If you note, line 6 has been, the wording has changed slightly. It used to say that it was the total amount paid by the borrower, that's you, for contributions to your employee's health insurance. And as we mentioned, payroll costs are now allowed to include contributions for any type of employee insurance, vision, dental, life, disability. So they just changed the wording there on line 6 to reflect the new law. Another piece that they've changed here is part of the reduction safe harbor number 1. And that's what we mentioned before, it was just in the certification, that if you are not able to be doing business at that February 15th, 2020 level, because of rules that were passed by OSHA or HHS or CDC, you have, and it's a new loan, a post 1227 loan, you can rely on those rules as long as they were passed until the end, before the end of your covered period. So that's just very similar to what we saw above, but here is where it appears in practice on the form. What about the Schedule A worksheet? Now, this is the hard one. This is the one where you need all those reports. Those of you who are with Viventium, I'm pretty sure you've already seen the FTE reduction reports and the wage reduction reports and dealt with them. This is like the real meat and potatoes where you have to go employee by employee and list their cash compensation, their average FTE counts, and there's 2 ways of calculating that, right? Sounds like a bit of a nightmare. So what has changed on the Schedule A worksheet? What's changed is the bottom, where you have a safe harbor, what we just looked at before, not being able to operate at the same level as February 15th, that's called Safe Harbor 1. Safe Harbor 2 has also changed. Safe Harbor 2 is the one that said, let me mention it earlier, and we mentioned there's also a mistake on the form, and here it is, that's why it's in red over here. The safe harbor is that if you reduced your counts between February 15th and April 26, 2020, and then you restored them by a certain date, you're not going to be penalized. And I'll call your attention to the contradiction between the form and the IFR that was issued by SBA. I'm imagining that SBA will probably catch this and correct it, but I would refer you to your legal counsel. What you'll probably be told is to follow the IFR because it's more authoritative than the form, but I'm neither a lawyer nor your tax advisor, so I'm not going to be the one to say that. What I will say, though, is if this exemption, if the safe harbor applies to you, if you need it, do be sure to check this out with your counsel. So what exactly is the problem here? The rule, the interim final rule, if you see it in yellow, says that as long as you restored your loans before December 27th or before the last day of your covered period. And I'm sorry, if you restored your amounts before December 31st, if you had a pre-December 27th loan, or if you restored it before the last day of your covered period for a post-1227 loan. So now I ask you, what if I restore, let's say I'm a post-1227 loan, and what if I restored my counts before the end of my covered period? And I want to already use that date as my payroll comparison date. Can I do it? According to the IFR, yes, you can. According to the form, you can't. The form, it locks you in. You have to use your numbers as of either December 31st for a pre-27 loan or as of the last day of the covered period. They're not saying by December 31st, and they're not saying by the last day of the covered period. Was this an oversight by SBA? Was this an intentional change or divergence from their interim final rule? I don't know, but I just want to try to have you understand that, and feel free during our question and answer time to ask questions about that. That is something to check out. Do you have to use only those dates, December 31st and end of covered period, or can you use any date up and until then, which is the way it used to be on the old Schedule A before the Economic Aid Act? Okay, and now, as I keep describing, we're actually going to do it. We're going to work through the forms, and we're going to see the flow of forgiveness. This is where we disassemble the form, and we figure it out, and we put it back together. So we're going to do a lot of color coding here. And again, for those of you who may have joined us in progress, these slides will be made available to you, as will the recording. I suggest that you keep them available, share them with your coworkers who are dealing with this. Listen to them again, keep this like laminated, put it up on your wall so that when you get up to doing this form, you have it here. Okay, so we're starting. We're on the new form dated January 19th, and we do all the standard information at the top. First line asks us for our payroll costs. That would be compensation, paid time off, and all those other employer contributions. Where does the payroll cost come from? Comes from over here. from the Schedule A. The Schedule A is a detail that flows into the main form. It comes from line 10. Line 10 says payroll costs, which is the sum of lines 1, 4, 6, 7, 8, and 9. What are they? Line 1 is your cash compensation from your Schedule A worksheet, Table 1. As we will see, that's for employees who earned under $100,000 in 2019. Line 4 is your cash compensation for Table 2 employees. Those are employees who earned over $100,000 in 2019. Line 6, 7, and 8 are all your employer payments. So that would be for your employee insurance, employee retirement plans, state and local taxes. And I want to stress, if you're working with a payroll service and they give you a state and local tax amount, keep in mind that very often, especially in the first quarter, you may have quarter end variances based on your state unemployment tax rates. And usually the amount showing in your payroll service as paid for state and local taxes will not be the same as the amount that you actually deposited. That's why I put that here right in big print. And you want to actually look at your tax service reports to see where there are variances. Did you pay in more, in which case you're entitled to more on this form, or did you pay in less because your rate went down? And that you will only know by looking at your actual tax deposit remittances that you receive from your tax service. The last line, line 9, is for owner employees. As we mentioned, special limits do apply to owner employees. And you want to, as a best practice, check with your payroll service provider, make sure that they're up to speed with this, as Viventium is, make sure they've done the modifications necessary, and that when they're running your reports, they're using the new limits for owner employees, not the old ones. And when you add up all those numbers, all those 6 lines, you get to line 10, which is payroll cost that flows through to your main form. Let's continue on the main form. So we had line 1 was payroll cost, and we knew that we got that from over here, from line 10. After that comes non-payroll costs, mortgage interest, business rent, business utilities, and the new ones, operations expenses, property damage, suppliers, and PPE worker protection. Those are all the costs that are going to factor in to figuring the amount of your forgiveness. But before we can get to add them up, we have a line 9 here, and line 9 says, you may have a reduction. If you reduced your employees' salaries or your employees' hourly wage by a certain amount, in excess of 25% per employee, then you're going to get your forgiveness reduced. And where does that number come from? Again, it flows through from Schedule A, which it says enter the salary wage reductions from Schedule A worksheet. Now, if you'll notice, these wage reductions are only for people in Table 1. If you look down at the Table 2 totals, there are no wage reductions. You are not penalized for reducing employees who earned over $100,000, or at least the annualized equivalent of $100,000, because the purpose of the law is not primarily to protect the paychecks of highly compensated employees. Up to $100,000, people who are earning up to $100,000, yes. But over and above that, employers are not going to get penalized for wage reduction. So the wage reduction is specifically for Table 1 people, those who earned an annualized equivalent of less than $100,000 in 2019. Then once we get that penalty line, we add up lines 1 through 8, and we subtract line 9. That means you get a dollar for dollar reduction in forgiveness for every amount of wage reduction. Of course, unless you're covered by a safe harbor of restoring it by whatever the date is. But if you're not covered by a safe harbor, we'll take a look at the summaries of some of the safe harbors at the end. I'll show you a nifty table that'll be great to use. If you're not covered by those, you've got to reduce your payroll costs and your non-payroll costs by your wage reduction, and then you get to line 10. And then you're not done yet. There's still another potential reduction, and that's called your FTE reduction quotient. If your headcount during your covered period is lower than your headcount during your look-back reference period, and none of the safe harbors apply, you will be penalized in proportion. Where does this number come from? From down here on line 13. It's called the FTE reduction quotient. It's basically like a percentage. It's the quotient of your average FTEs during your covered period, okay, divided by your average FTEs during your look-back reference period. And you have a couple choices of periods that you can choose, but if it's a fraction, If it's less than 1, then you're going to get penalized, because look what's going to happen on line 12. We're going to take your line 10 modified total and we're going to multiply it by the fraction. So let's say it was only a half. Let's say your FTEs during your covered period were 50 and your FTEs during your look back period were 100. We're going to do 50 divided by 100. We're going to only get to 0.5. We're only going to get to a half, and your forgiveness amount is going to get slashed in half. Again, unless safe harbors apply. Now, we mentioned these special limits about owner employees, and I told you best practice, check with your payroll providers that they're aware of this. You can share this slide with them. This is a quotation, direct clip right out of the form and the instructions to the form. Let's look at it carefully together. And this is for those employees who own a more than 5% share in the business. Okay, they're called owner employees. For anyone that's falling into that category, so the amount that you can include on line 9, the amount that you can include in, let's look back a second. Line 9 is over here. That's the total amount paid for owner employees down here. Okay, the amount that you can include in line 9 is capped at the lower of either $20,000, $20,833, which is 2.5 months of 100,000, or the 2.5 month equivalent of their actual compensation in either 2019 or 2020, whichever one you use to compute your loan application. An additional restriction, you need to be aware of it. And if you have owner employees, you need to make sure that the reports you're getting are supporting this. Now, after we've done that, we've gotten down to the FTE reduction quotient. We're going to take that quotient and we're going to multiply it by the preliminary forgiveness. It's going to get reduced, and that will be the amount that we're actually going to try to get forgiveness for. But that's further limited, of course, by what's up here, your PPP loan amount. You can't get forgiven for more than your loan amount. Let's say you had a tremendous amount of payroll expenses and even non-payroll expenses, right? And let's say you didn't have any reductions or very little reductions in your wages or FTEs. You can't get back more than your loan amount, obviously. So it's being capped at either your loan amount or your modified total. Similarly, here's the 60% rule. At least 60% of what you're looking for in forgiveness has to be made up of payroll expenses. So they're going to ask you to take that loan amount, and divide it by 0.60 and put that number here. And the amount that you're getting forgiven for is going to be the smallest of either line 12, 13, or 14. That's going to be your bottom line of forgiveness. That's how we finish up. Now, what about Schedule A and how the Schedule A worksheet flows into Schedule A? This is kind of like the scariest part. It's also going to be our most colorful part. We know that you have two tables. Table 1 is for people who earned less than or equal to $100,000 in 2019. Table 2 is for the higher earners over 100,000. Now, I want to stress, sometimes you may look at your payroll service reports and you may say, hey, there are people on here who for sure didn't earn over $100,000. What are they doing in Table 2? I'm actually happy to see them in Table 2 because I don't have to worry about wage reduction, but this might be wrong. So I want to call your attention to the words that the SBA uses here. And they speak about an annualized rate of 100,000, an annualized rate of more than 100,000. What does that mean? That means if an employee received 1 or 2 paychecks, but very high ones, and they were weekly paychecks, even if they received only those 2 paychecks and their total pay didn't exceed 100,000, but if they were, let's say, taxed on a weekly basis, and when you annualize them, they bring your amount up to and above 100,000, then they're going to be legally qualified to be called annualized rate people, and they're going to be in Table 2, which is good news for you. So let's first look at Table 1. We're going to take the total cash compensation. Remember, each person gets capped at their 100,000 annualized amount. So again, if you're using a 10-week covered period, if that's what you've elected, it'll be 10 over 52 times 100,000. That'll be the cap, the most that you can include for any employee in this table. Viventium subscribers, you have it made. This is all supported for you. It goes over here. Cash compensation flows into line 1 for Table 1. Then the average FTE amount, again, it comes from each employee. You have to go through, there's 2 different ways to calculate FTEs. Not going to get into that now. If you want to look back at some of our webinars, there's one called Foraging Through Forgiveness, which has a detailed explanation of the two methods of FTE. There's a simplified method, there's an exact method. You can pick which is best for you as long as you're consistent with it. But you have to go employee by employee, and hopefully your payroll service should give you this report, as Viventium does, and take that average FTE number and flow it through here to line 2. And then finally, for table 1 people only, you have to do the salary reductions, and this is only if you reduced for any employee more than 25%. So if an employee was earning at a rate of, let's say, of $10 an hour, let's say they're in a state that allows such a minimum wage, $10 an hour, right? So if you reduce them to $7.50, you're not going to get penalized. It's only if the reduction brings them down to more than $7.50. So that wage reduction flows through to line 3 of the Schedule A. And similarly, Table 2 also has cash compensation. Those are for the highly compensated. It has FTEs that flow through, but the wage reduction does not flow through. That's a missing column over here. For those high earners, there is no provision for wage reduction. And as I mentioned at the beginning or throughout, this is a little bonus here. You have a very great, I really like to summarize things on one page. When I have it on one page, it makes me feel safe. Okay, so these are safe harbors. Some of them are for salary and wage, some of them are for just FTE. We're going to take a look at this. Viventium will be releasing this in an infographic format. I mentioned you'll be getting a complimentary infographic at the end of the webinar. And Viventium will be releasing this as well in the upcoming days of PPP gearing up. So there are 6 available safe harbors. 3 of them apply to wage reductions, and 4 of them apply to FTEs. There's one that applies to both. If, as I mentioned before, if the reduction for any given employee is not more than 25%, meaning that during your covered period, their pay was at least 75% of the look back period, and you cannot choose the look back period for wage reduction. It is January 1 through March 31 of 2020. But if the reduction is under that threshold, then you're not going to get penalized. It doesn't have to get counted, and it's not going to flow through and reduce your forgiveness. Similarly, as we mentioned, any highly compensated employee, meaning they earned over $100,000 in 2019, we don't care. We don't care if their salary was reduced, even if it was reduced 50%. It doesn't matter. You're not going to be penalized for that. And there's one last safe harbor that applies to salary reductions, and this is the one that I've kind of been harping on, and that is if you have any reductions between February 15th and April 26th, if that's when your reductions happened, but you restored them by 12/31, and I'm putting the word by in there, even though the form says on 12/31. I'm going with the interim final rule that says by 12/31, and if you're taking a post 2027 loan, it is by the end of the covered period, not necessarily on the last day of the covered period, which is what the form says. Again, I'm not trying to adjudicate this question. I want you to take this to your tax advisor or to your authorized lender. But for the purposes of this safe harbor, I'm taking the interpretation of the IFR, which is that if you restore your wage reductions by these dates or anytime earlier, then you're okay. Then you're not going to get penalized. The same safe harbor applies to FTEs. And when it comes to FTE, that's known as Safe Harbor 2. You'll see that on some of your reports. You'll see that on the form. Safe Harbor 2 means you have restored your FTE, your headcount reductions, either by December 31st if you have an earlier loan, or by the end of your covered period in 2021 if you have a post 12/27 loan. What else can get you out of the FTE pickle? If you did not reduce your employee or your paid hour count between January 1st and the end of your covered period. Now, there is no more, it used to say alternative covered period, but there is no more alternative covered period, so it's just the end of your covered period. Or if you have a reduction exemption, which means you reduce someone's working hours, but it was due to something allowable. For example, the employee voluntarily terminated, or they were discharged for cause, or you offered them to come back to work, and you also reported that offer to your state unemployment office, and they turned it down. They said, no, we're not coming back. Or you tried to hire, I think we saw this before in the IFR, you tried to hire someone who would be an equivalent to do their job, to make up for their, and you couldn't find such a person. So these would all be reasons that we don't count the FTE reductions. And finally, the one we had mentioned before called the Safe Harbor 1, you're not able to operate your business at your pre-COVID level, pre-215 level, because of federal government rules that were issued from March 31st through 12/31, or for later loans through the end of your covered period. That's called Safe Harbor number 1. What about the look back period? So we mentioned that for wage reduction, you don't have a choice. Your look back period has to be January 1 till March 31. What about for FTE look back? So the 2 fixed periods stay the same. It's either you get you get a period in 2019, or you can choose to use January 1st through February 29th in 2020. That's also good. But what if you're a seasonal employer? So there's a change for you. Again, for non-seasonal employers, nothing has changed about the look back. The change is only for seasonal employers. The old way was you could pick any 12 weeks between May 1st, 2019 and September 15th, 2019. You had to reach back to 2019. They've expanded that and they've broadened that basically. And they've said you can now take, if you're a seasonal employer, you can now take any 12 weeks that fall anytime in the entire year between February 15th, 2019 and February 15th, 2020. You'll want to use the look back period that has the lowest FTE count, because that's the standard that you're going to have to live up to. So you could use a time that's out of season, and that you're really not employing that many, your FTE is low, and that's great because that sets the threshold that you have to reach at quite a low threshold. So that would be a best practice choice that you want to make. Take the lowest FTE look back period. 2 important pieces of coordination. I mentioned this at the beginning. The employee retention credit is now available to employers, even if they took the PPP loan, actually available retroactively. You can actually go back and amend your employment returns for 2020, second, third, and fourth quarters to get those credits. However, see what it says here in yellow. Do not include any wages that you use to determine your retention credit in your PPP eligible payroll costs. That much double dipping they're not going to allow you. If you got an employee retention credit, which means the Treasury is basically participating in the wages you're paying to your employees by letting you reduce it against your tax, well, don't expect them to also allow you to double dip and claim those same wages, toward forgiveness. So any wage is either used toward the ERC or toward the PPP. Again, I want to reassure all of those of you who are with Viventium that this is fully supported in our system. Those of you who are not yet with Viventium, I want to encourage you to, as a best practice, take this back to your provider. Make sure that they have the ability to do that so that you're not double dipping and you're not getting something that's later going to come back to haunt you and you'll be told, no, this is being disallowed or worse. Another important piece. This is what I mentioned before, but here we see it right here in the instructions, the January 19th instructions. For each individual employee, the total amount of cash compensation may not exceed an annual salary of $100,000 as prorated for the covered period. So they picked the old examples. 8 weeks, the maximum is $15,385. 24 weeks times 100,000 is $46,154. I would have wished they would have picked like some, more exciting examples that we haven't seen yet, but it's okay, and we get the idea. This is how we have to prorate the amount of payroll that we're allowed to include. And again, I want to stress that it's so important to have a payroll service that fully understands this, that's on top of it, and that the reports are going to have this accurate cost, because this is what your forgiveness is going to be based on. A couple of bubbles to keep in mind. You cannot count non-US residents when you figure your payroll costs, even if they're citizens. Someone might say, well, I work on I have a social security card. If they're not resident in the United States, that is not what the PPP program is coming to protect. I mentioned this in passing, but I want to stress it here in this bubble. If you want to get that reduction exemption and you laid off an employee and now you're offering to rehire them, it's not enough to just call them up and say, hey, want to come back to work? It's not even enough to issue them an email or a written documentation that you actually have to issue it to them in writing. You have to get their refusal and you have to report their refusal to the state unemployment office. Otherwise, you're not going to get the forgiveness exemption. If you must reduce pay, do try to keep your reductions less than 25% per each employee relative to first quarter of 2020. That's something to keep in mind when you if you do need to make difficult budgetary cut decisions, try not to have any one employee, at least none of your under 100,000 employees, try not to reduce anyone by more than 25%, if that's at all possible. We talked a little bit about the two ways to calculate FTEs. We talked about the exact method and the simplified method. We're not going to get into the detail here, but keep in mind that if most of your part-time workers are part-time less than 20 hours a week during your covered period, then you may be able to maximize your grant amount by using the simplified calculation as opposed to the exact method. In Viventium, you have the choice. We give you calculations using both the exact and the simplified, and at a glance, you can see which one gives you the higher FTE quotient, the higher number, which is better. So that's available to you. And finally, as we mentioned before, what you want to be doing, since you have a choice of your FTE look-back period, you don't have a choice of your wage reduction look-back, but you do have a choice of your FTE look-back. You do want to go ahead and choose the one that gives you the smallest FTE count, because that's the one that you're going to have to be living up to when you figure your forgiveness. And as promised, now as we're drawing close to the end, this is going to be distributed to you when you receive the slides. It's just a nifty reminder. Sometimes we get so lost in how many changes have there been, and which form are we supposed to be filling out. So as we progress through the history of PPP, we get up to the two dates that concern us the most. December 27th, that was when the Economic Aid Act was actually passed into law, and that reopened the program both for first and second drawers. And then January 19th is when all these new forms, the 3508, the EASY, and the S, they were all released. There's also a form called 3508D, which is a disclosure form for certain government officials. Probably won't apply to most employers, but now there is, just to mention, a fourth form as part of the 3508 series, and those were all released on January 19th. Now I want to take some time with the remaining few minutes that we have to address some of the questions that have come in. And again, I want to thank you all for asking these questions. I invite you to stay around for the answers. If you are leaving, and at the point that you leave, if you'd be interested in finding out more about Viventium's product and services, even if you're already a Viventium client, but you might find some of these services intriguing, you didn't even know that was available, I would invite you to take the one question survey on exiting from the webinar and let us know how we can be of help to you. So we're going to address some of these questions now. First question, can the safe harbor FTE calculation be for any pay period after the covered period? So I think this question is the one we were addressing, that in other words, how long can you see if you, how long do you have to see if you restored your FTE numbers? And as we saw, it has to be, if it's an earlier loan, a pre-1227 loan, you have up to and until December 31st, even if it's after your covered period that ended in 2020. But if it's in 2021, in other words, a post-1227 loan, you only have until the end of your covered period, at least under the current guidance. As we've seen, guidance may change, but that's what it is right now. Next question. If we received a loan and have already applied for forgiveness, how do we recall that and request an increase? So we mentioned that at the beginning, and the answer is you need to contact your lender, your authorized lender, and see if it's still a possibility. If you actually got the forgiveness grant already, then there's unfortunately not going to be too much that you can do. If you're in that twilight zone of having brought the forgiveness application, submitted it, but have not yet gotten a decision, perhaps that will, you really need to check with your lender about that. Next question, what about getting additional first PPP draw if you qualify? Yeah, you definitely can. Under the law, you can get an expansion of your first draw if you've discovered that you now have all these additional, you have the PPE expenses, operations supplies, property damage, or payroll expenses, additional insurance, disability, vision, health, long-term, all life insurance. That's, yeah, you definitely can expand your first loan, but not every lender is geared up to let you do that yet because SBA has not yet explained how to do that yet. There's no 3508I for increase or something like that. We're waiting for something. And I know that at least one lender is not supporting that yet at this point. Question. If I didn't apply for the first one yet, but now qualify due to the change, can I still get both? Yeah, well, the answer is you can't get two loans at the same time. Meaning, if you never got a first draw loan, then sure, you can go ahead and apply for your first draw loan, use it up, and then if there's still funding left in the program and it's still before March 31st, then you can go ahead and apply for a second draw. You can't jump into a second draw if you didn't use up your first draw, and you can't have used up your first draw till you got it. So I think just by, process of elimination, you first have to get a first draw, use it up, and then you can go for your second draw. Question: I took the employee retention credit before, and now with the change I can take both, but can I go back to get the PPP? Okay, so if you did not yet take a PPP loan, you can't retroactively submit an application with an earlier date. In other words, it's nice that they gave us the employee retention credit retroactively. That was really nice. But there's no such thing as a retroactive PPP loan, meaning you can apply now for a first draw loan, but not go back retroactively. And I think we have time for just one more question, and I'm going to thank you all for attending. Question: if your original PPP loan was greater than $2 million, because remember, you could have gotten up to $10 million, can you now go back and ask for additional loan for the new allowed responses, meaning asking for additional PPP loan, even though you already received over 2 million? It's an excellent question, and it's not entirely clear to me. In other words, let's say you've already gotten a $3 million loan. Now you have all these new expenses, so you want to go and ask for $4 million, but you're doing that under the provisions that say new loans can't exceed 2 million. That needs to be checked carefully with your authorized lender to make sure, because from the way it sounds, the total new loan can't go over 2 million. So that's what I would assume, but I would urge you to check with your lender on that. And with that, we're actually a minute over. So I want to thank you all very much for attending today. Encourage you, if those of you who feel it might be helpful, to attend another session where we discuss forgiveness for loans that are $150,000 and less, and some important points there. And as always, to encourage you to visit our COVID-19 solutions page at Viventium.com. I'm Yonina F. Shineweather, wishing you much success in getting full forgiveness for all of your loans. Thank you, and have a great day.